Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Stocks and bonds remain on shaky ground ahead of tomorrow's U.S. jobs report. One-time bond king Bill Gross weighs in on the meltdown.
We're seeing a little bit of an oversold market here headed to 5%. A 5% 10-year Treasury is decent value. It's not great value.
Oil's steepest drop in more than a year continues amid growing concerns over weakening demand. And Barclays dismisses 50 senior deal makers. We speak to a Wall Street veteran, Tom Naratil, who's making his mark in private equity. A very good morning to you all. Danny, we are held hostage to the daily terrorism of data, whether it's on the oil market or the bond market. I can tell you this, as far as the bond markets are concerned, we had this parabolic move higher, and it is continued. Bill Gross, there, you heard him say, is not great value at these levels. And it's interesting when he talks about who are the bond vigilantes. They're no longer the institutions that bonfire the vanity institutions here on Wall Street, but it is you and me, individuals who are taking the pain and capitulating. That is the interesting point. By the way, it's going to take a heck of a lot more of a dump in the stock market before anything comes to the rescue of the bond market. More on that Barclays note in a moment. Oil is down. Again, continuing. The data is turgid. Gasoline demand, the weakest in 25 years. That is what irked this market. We are in demand destruction. JP Morgan have made it really, really clear. Demand destruction is here, and still Saudi and Russia go ahead with their cuts. Dollar yen, I thought we'd just put it in there. Every day we're checking whether did they intervene, didn't they intervene. Well, we have the data, a little bit of data now to suggest perhaps the Bank of Japan did not intervene. I want to leave you with a snapshot. Look at that two-day move in the oil market, down 6% yesterday. And here we are. We continue lower again. What does that mean for central banks? What does that mean for global demand? What does that mean for recession watch? Danny Berger, good morning.
Good morning, Manus. It's the downward momentum that's concerning, right? We did have this turnaround in bonds and equities yesterday after the ADP report, as you pointed out. But it is concerning that we're unable to hold on to that. It doesn't bode well for whether this was actually a turning point. Your S&P futures down 0.4%. Just as an example, here's what the market did yesterday. NASDAQ ended the day up nearly 1.5%. Somehow, amid all of that, Europe is able to eke out some slight gains, but just slight, up about 0.1%. Emmanuel Coe says that at the moment, cash is the only thing that is attractive, that stocks are going to fall further with yields moving higher. But Manus, we've talked a lot about how historic this bond rout has been. Let me put it into a picture for you to show our viewers just how bad it is. For our radio listening audience, I have a Bloomberg index that is basically long-dated bonds from the peak to trough of how bad the drawdowns have been. We'll get to that chart in just a moment. Manus, the drawdown basically is half from the peak of March. We've drawn down about 46%. There it is. That rivals the bad meltdown we saw in equities in the dot-com bubble burst. That's just how bad this drawdown has been.
But Danny Berger, you know, when you buy bonds, you buy them to maturity. YTM, yield to maturity. So that bloodbath, I mean, I'm trying to give myself a reason to sort of look at that chart and go, is there any reason why you would continue to hold it? Are we at a capitulation point of where there is divestment? Barclays have a cracking big note out this morning. They say, look, there's no magic level in these bond markets. You know, and the 5% drop that you've had in the equity market, as I just showed you, is not going to be enough to save the bond. In other words, you're not going to turn around and say, I'll buy bonds because equities are down by 5%. It's going to take something an awful lot more, Danny.
Yeah, it's this weird chicken or the egg thing, I must say, because there are people out there who say yields need to go higher for stocks to sell off, but then apparently stocks need to sell off for yields to stop going higher. It is melting my mind. All I can say, Manus, is this doesn't look good. That's the only one thing I can say for sure.
Well, we don't want your mind melting, but our next guest says there's nothing worse than being higher for longer in this paradigm world. It's Orwellian doublespeak for where good news is bad news, strong is weak, and high yields hurt equity multiples now and corporate profits in the future. What's she doing about it? Is her head melting? Marija Veitmane is Senior Multi-Asset Strategist at State Street. Are you so chastened that you want to run to a mountain of cash? Marija, good morning.
Yeah, good morning, Manus and Danny. Yeah, I think, I mean, it's very difficult. I mean, mostly a very positive and optimistic person, but it's really difficult to find something to get excited in financial markets other than cash right now. So to us is that the U.S. economy is still strong enough, and that is going to keep Fed on its toes, and that's higher for longer. And we see what it does for bonds, we see what it does for stocks. So cash seems to be really the only reasonable alternative.
What do you make of this Barclays argument, Marija, that once stocks sell off, then bonds can stop their sell-off?
Well, I think it's about economy. It's not about financial markets. And I think central banks, and Chairman Powell showed it to us many, many times. He cares a lot more about inflation, about real economy, about labor market than stock market. So I think the question is at what point labor market slows. It's not at what point like stocks crack.
Yeah, but then you look at the JOLTS data, and that ripped the bond market apart. And then you look at the ADP data yesterday, the least amount of private jobs since 2021. And suddenly everyone, oh, great. You know what? We have a relief. So it's ultimately the jobs market that's going to stop the rot in this bond market, Marija, but it doesn't look as if the US is about to crack anytime soon.
Yeah, no, I agree with that. I suspect, we know that JOLTS numbers are volatile. We know that ADP numbers are volatile. So one was too strong, other was too weak. So truth is probably somewhere in the middle. I would probably trust JOLTS a bit more than ADP, but we have payrolls on Friday, so to add more confusion to this discussion. But if we look at GDP revisions, if we look at economic surprises, if we look at consumer sentiment, so there is still enough strength. So consumer is still spending. So until that stops, I think we are in higher for longer. So I think it's a little bit early
Marija,
to
why
look
can't
for
why can't I say, okay, the consumer is spending more, the economy is doing strong, sure, higher for longer, but that sounds like earnings will be fine. Why can't stocks be okay in that environment?
I think higher for longer means that recession will happen. It won't happen this quarter. It's probably not going to happen next quarter, but it will happen. Why consumer has been so strong? They had savings and they had a very, very low interest rates cooked in before COVID, before rates started to go higher. All that is running out. It can't be there forever if Fed has increased its interest rates that much. So we haven't seen recession, but it doesn't mean that monetary policy doesn't work. We just wait a bit more, and we will already see cracks happening. So we'll see more and more of that.
Well, Marija, the crack certainly came to pass in the oil market yesterday. I haven't seen many 5.5, nearly 6% moves in the oil market. Down she went by 6% yesterday. And yet, if you look at this, you say oil will stay high. Saudi Arabia and Russia are continuing with their cuts. But what I love to know when you find somewhere that's not too crowded, why do you think the energy trade is not too crowded? Is it the commodity side of the trade or the equity side of the trade?
Equity side for sure. So, at State Street, we are privileged to see what institutional investors within our custodial database are holding. And the holding overall in energy stocks have increased from fairly low level. Investors bought energy stocks, but they haven't bought enough. So there are still opportunities there. We also see energy stocks lagging energy oil prices. So there is some catch up there. And energy stocks generally look really attractive. They're probably one of few stocks that can generate a lot of cash now. They can afford fairly hefty dividends. So in a world, like in my world, where I'm really worried about recession and I want to run away from stocks, maybe there are relative opportunities in energy relative to, say, industrial or materials. So to me, that trade looks attractive.
See, Marija, you said you didn't think there's anything you could be optimistic about. You found it. So we're all happy about that.
Just ask me about tech.
Oh, you want to get into tech, Marija? We got a minute left. Take it away. What's your thought on the Magnificent Seven right now?
Oh, love them. I think if we're going into recession, we do need to find somewhere where you have quality earnings, and earnings can be defended, can be stable, have stronger cash flow, and that's definitely not banks, that's not industrial, so you might have some sprinkling of like healthcare, but tech sector is something that is proving itself to be somewhat resilient, and high valuation doesn't worry me, long enough.
Marija, thank you very much for that. That is Marija Veitmane of State Street. See, giving us two things to be positive to wrap it up with.
Reason to be cheerful.
All right, Manis. We need it. All right, Manis, now to some of our top stories. Take it away.
Okay, we've got the Florida Republican. Matt Gaetz says he backs speakership bids by both Representatives Steve Scalise and Jim Jordan. He spoke to Bloomberg yesterday.
I'm for both of them right now. I'm eager to hear their plans and their vision. But if the House of Representatives goes from the stewardship of Kevin McCarthy to either the stewardship of Jim Jordan or Steve Scalise, that's going to come to the delight of many conservatives.
Elsewhere, Caroline Ellison, the former CEO of Almeida Research and Sam Bankman-Fried's former girlfriend, has quickly become the focal point of the FTX, if I can find my word, founders fraud trial in New York. Bloomberg's Sonali Basak filed this report.
Over the 6-week trial, dozens of high-profile testimonies will include Caroline Ellison, Bankman-Fried's former girlfriend, and investor Anthony Scaramucci, whose firm had taken money from Bankman-Fried's firm. They are expected to testify with dozens of others, and the defense still says working at a startup is like building a plane as you're flying it, and that no one CEO or person can be everywhere while managing such a fast-rising firm. Remember, FTX had almost 6 million customers at its peak. Bankman-Fried may spend most of his life in prison if found guilty. I'm Sonali Basak in New York for Bloomberg Television.
And Barclays is dismissing about 50 senior deal makers. The layoff is said to be part of a plan to trim headcount by about 300 people across the corporate and investment banking divisions. That amounts to 3% of the total headcount at the unit, which includes Barclays' trading operations. And later this up, we speak to Tom Naratil, former top executive at UBS, who's now making his mark in the private equity world. Up next, another hurdle for Congress. U.S. aid for Ukraine hangs in the balance as the scramble for a new House Speaker continues right here on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Krani in New York. Matt Gaetz, the Florida Republican who led the push to oust Kevin McCarthy as House Speaker, discussed government spending with Bloomberg's Anne-Marie Hordern and Joe Matthew on Balance of Power.
I think that the downgrade from Fitch was largely driven by the fact that there's no real backstop to spending. So here's what we need, no matter who's the speaker. We need a top-line budget that, at least in the House of Representatives, returns to pre-COVID spending levels, and then we need to be able to have single-subject spending bills with open amendments to have programmatic review of agency spending.
Well, Congressman, let's talk a little bit about what just happened. Nobody's ever done this before. It was history-making yesterday, the ouster of the speaker. We're told that you are the least popular man in the House of Representatives, or at least to the Republican conference. In fact, just yesterday, your Republican colleague from New York, Mike Lawler, suggested violence against you in an interview right around this time yesterday. I'd love for you to hear what he said and have you respond. Here's Mr. Lawler.
The only thing that I would have done differently is flung it in the direction of one person. Look, he absolutely epitomized the frustrations of the conference and the American people.
Was that person from Florida you're suggesting?
Oh, yeah, I would have hit him square between the eyes.
He was going to hit you square between the eyes with the speaker's gavel, he was suggesting, Congressman. Do you expect to be expelled from the Republican conference?
Oh, I don't know. I think that was a very frustrated person who's having to come to grips with the stages of grief. My mission is to ensure that the House of Representatives runs better, because the way we've been running Washington, D.C. for the last 30 years has led us to a point where no one is really responsible for the spending. We are backed up against shutdown politics. We are governed by crisis. And the biggest problem is lawmakers have to take one up or down vote on continuing resolutions and omnibus bills to either fund or not fund the entire government. That truncates the type of thoughtful and serious analysis that we have to apply to how the federal dollar is being spent at a time like this.
Representative Matt Gaetz there on Bloomberg's Balance of Power. President Biden is planning a major speech on the need to give additional aid to Ukraine. He spoke about his plans last night.
We can support Ukraine in the next tranche that we need, and there is another means by which we may be able to find funding for that, but I'm not going to get into that now.
Now, support for Ukraine is top of the agenda also as European leaders meet in Grenada today. Joining us now from there is Bloomberg's European correspondent, Marija Veitmane. Marija, is there a lot of cohesion when it comes to Europeans' plans for long-term assistance in Ukraine?
Look, we're about to find out. And in fact, President Zelensky has just arrived to this conference that is taking place in Spain today. And it was not a given, we should note, that he would attend the summit. In fact, at the start of the week, we were told that he would not attend, and instead the Ukrainian prime minister would take his place. Instead, he had a change of heart yesterday and decided to be here. And you can tell the incentive for the Ukrainian government, because this has been a difficult week for Ukrainian diplomacy. On the one hand, of course, we had the shutdown deal, which left some of the aid for Ukraine outside of the package. Then maybe this seems trivial, but there was a post by Elon Musk which showed a man that was sweating, asking for cash. That was supposed to be President Zelensky. That infuriated Ukrainians and, in fact, has circulated in terms of the zeitgeist of maybe public opinion turning away from this idea of stand with Ukraine for as long as it takes. So today, the Ukrainian president, of course, is going to have a number of bilateral meetings with European leaders. But beyond that, there's also the optics of this meeting. He wants a picture, a photograph that shows he is engaging with international leaders, that he's not alone, and Ukraine is not alone in this war.
Marija, good to see you this morning. How concerned are the European leaders about this waning U.S. support?
Look, Manis, and one thing to know about European leaders, especially when we talk about the European Union, is that for them, until now, the Biden doctrine had been very, very easy to read. They knew that meant weapons for Ukraine. They knew that meant support for the country, and also meant money, funding for this country. Obviously, that could change in an election year, and we see it play out with some of the political instability, perhaps, that we've seen already play out in the United States. So this was a concern already going into the election. It was talked about privately. This is not new. European leaders were obviously positioned potentially for this election, and maybe even a change in government in the U.S. But I think this week what they have seen is this is a controversial issue. It's playing out very publicly in the United States and has accelerated some of those fears. It also brings up a big question as to what happens if the United States pulls back from the Biden doctrine. What I should say, however, this morning there is a lot of curiosity in terms of that speech that the president said he would make. Remember, he said a major speech about the need for long-term funding for Ukraine. He said that even if Congress does not approve, there's still ways to get money for Ukraine. That's something that's gathered a lot of attention here.
Well, it's only going to be interesting to see what happens in the next 40 days and where we land on this. Marija, thank you very much. Marija Veitmane in Grenada in Spain. And a quick check on these markets. 24 hours ago, there was a moment of reprieve in these bond markets in terms of them rolling off their highs. You can see yields rising ever so slightly this morning, 475 on 10-year government bond yields. They're not great value, according to Bill Gross, just yet. This is Bloomberg. This is Bloomberg Brief. I'm Menace Granny in New York, Danny Berger at London HQ. So Walmart says it's already seen an impact on shopping demand from people taking the diabetes drug Ozempic and other appetite-suppressing medications. The retailer is studying changes in the sales patterns using the anonymized data. There's a word for you, anonymous data, from their shopping populations. Danny.
I just want to know how we're talking about Ozempic for a second day in a row. Got to stop the madness.
Well, I just don't want to say. All I said to you yesterday was it's half the price in Dubai than it was here. Danny, good morning.
Good morning, Manis. We'll leave it at that. All right, let's talk about football, because the World Cup, it's coming to North Africa for the first time. Morocco is set to co-host the 2030 tournament, along with Portugal and Spain. But the event will also see a game played in 3 South American countries. Here to explain is our resident football expert. It is Bloomberg's Greg Tanner. Greg, so explain this to me. If I'm a fan and I want to go see a match in Uruguay and then just shimmy on over to Morocco, or even a player for this matter, I mean, how is that going to work?
Long flights, time zones, jet lag, probably. It is complicated. I think the tournament proper being split over 3 countries is unusual, but it's not unprecedented. In 2002, we had the World Cup split over South Korea and Japan. The one coming up in North America in 2026 is going to be the US, Canada, and Mexico. So the fact that they split it over 3 countries isn't that surprising. What is surprising are these 3 games at the beginning of the tournament in Uruguay, Argentina, and Paraguay. And they're basically, what people are believing, throwing them a bone, that they didn't get the tournament proper. It's the centenary. It's 100 years since the first World Cup was held in Uruguay, and they won it. So the feeling is they've given this consolation prize. You can have 3 games, but then the tournament proper will happen in the other countries in North Africa and Europe.
Well, our consolation prize is that you're in London and not in the Middle East, and that you said yes, you'd stay late. You'd stay late at school and be with us. So come on then, what's going on with Saudi Arabia? I mean, they can't be left out of anything to do with sports. Quick line, we've got 30 seconds. What's the top line for Saudi?
Well, there had been thoughts that they might have gone for the tournament that just got awarded with Greece and another country. They didn't do that, but they have confirmed they are going to apply for 2034, and it's only going to be somebody out of Asia or Oceania who is in the running, so they got a good shot.
Well, you know what, Greg? I've got a bit of form in covering football in Qatar with the odd header here and there, so if you're looking for a correspondent, I'm on the block. Greg Tanner, transplanted to London from Dubai. Next up, Tom Naratil. Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Stocks and bonds remain on shaky ground ahead of tomorrow's U.S. jobs report. One-time bond king Bill Gross tells Bloomberg treasuries are just a little oversold. Oil claws back some gains and then falls again after falling the most in a year amid growing concern over weakening demand. And Barclays dismisses about 50 senior dealmakers. We speak to a senior dealmaker ourselves, a Wall Street veteran, Tom Naratil, who's making his mark in private equity. Meanwhile, here in public equity land, we're unable to sustain the gains of more than 1%, at least for tech stocks yesterday. It is a bad sign that the turnaround is not taking hold. We're back down again, down about 0.4% for both S&P and NASDAQ futures. European stocks are holding on to something. I'm not too sure what at this point, but we are a little changed. And of course, Manus, Barclays warning that stocks need to look a lot worse. A 5% drop isn't enough to steady the bond market at this point.
No, not at all. And it doesn't even look like tantalizing value for Bill Gross either in the bond world. Marija Veitmane from State Street just with you and I saying she'd prefer to be in cash at the moment. Let's check in on these yields. You saw parabolic rises set off by the JOLTS number on Tuesday, a reprieve yesterday on ADP, adding the least number of jobs since 2021 in the US. But still, these yields are incrementally pushing higher. Bill Gross says the market looks a little bit oversold. The vigilantes of old, in other words, those Wall Street institutions and asset managers, perhaps are being challenged by who the vigilantes are of today. They are individuals like you and I who are long ETFs, who are hurting brutally. And if you look at the collapse in the bond market by over 50% from its highs just a couple of years ago, oil continues lower. This is a cascade lower in the oil market. You saw it drop by nearly 6% yesterday. We are in the world of demand destruction. That's according to JP Morgan. There you go. Again, we continue lower. Demand destruction is live. Why? Gas demand here in the United States of America is the weakest in 25 years. So is that an anomaly, or is it something that will continue? Dollar yen, you see the dollar slightly on the back foot today, ever so slightly. And with that in mind, it transfers into dollar yen. We've got a little bit of data through on the current account, on the current account data from Japan, and that says very clearly that for now we don't think that there was intervention in the yen. Danny.
Yeah, look, it's an interesting one, and also interesting. You pointed this out to me that we also heard from Richard Clarida. He was, of course, speaking, he had a note out saying that at some point Japan will have to abandon YCC, and that point will come soon. Again, it goes back to this Kit Jukes thing of earlier when we spoke to him, Manus, saying you cannot have your cake and eat it too. You cannot try to keep the bond market in this band and at the same time have a currency that doesn't appreciate. So Bank of Japan still forever in focus for us.
Absolutely. And then you got Marko Papic a little bit earlier in the week talking about the possibility that an uncontrolled bond market in the United States of America could invoke YCC. Anyway, let's shift the conversation along. YCC is a long way down the road, some would say, here in the USA. One man that's seen a season or two in the bond markets, in volatility, in raising capital and doing deals is Tom Naratil, previously holding several senior positions over the past 4 decades at UBS, including co-president of UBS Global Wealth Management and president of UBS Americas. He's now an operating partner at the private equity firm Lightyear Capital, where investments are in wealth management and financial services sector. Good morning, Tom. Good to see you.
Good morning, man. It's great to see you.
You've gone to the dark side, private equity. I hope they've welcomed you. The fund, talk to us a little bit about the fund. I think there's about $4 billion in it at the end of last year. So set out your stall. Where are you going to take that fund to? How big can you grow it? And are you actively raising money at the moment?
So let's talk a little bit about what I'm doing, what I'm focusing as an operating partner, because I'm part of a larger team at Lightyear. My focus is on the asset and wealth management space, not surprisingly, given my background. And that's a great place where Lightyear's had a tremendous record in terms of helping companies to raise growth capital and to help them succeed and grow in the future. So that's what I'm going to be focused on.
And with that in mind, I mean, I look around the wealth management space, and there's this debate, isn't it, with Jamie Dimon talking about AI, doing the hedging for them, being involved. For us, with this fund at Lightyear, is it AI deals that you think you're going to look at more in the wealth management space, or is it human capital? Is it still, Manus, I still believe that wealth management needs a large element of human capital. Where does the balance come?
I would say it's tech-enabled wealth management. AI is going to be extremely important to the wealth management industry, but the best parallel is if you think about software developers and GitHub, they have Copilot, which actually assists software developers in becoming more productive, learning what different coders are trying to do, what their style is, and giving them prompts along the way as they're working on code. I've seen demos of fintech that is setting up to help client advisors to be able to do the exact same things as they're engaging in conversations with their advisors, with their clients.
Hey, Tom, Danny here in London. Really great to speak with you. Even beyond just the technology revolution, in today's plain basic vanilla markets, it's tough. 60-40 is getting pummeled. A day like yesterday where commodities sold off, risk parity is struggling. And then you have all these cheap ETFs you can go out and buy are really accessible. So where do you think asset management and the companies that you're looking at fit in that world?
Yeah, so Danny, you definitely described the problem out there quite well. I think what you're describing tells you exactly why the wealth management industry is in a bull market for advice. There's so much going on out there. If you think about just the amount of content that you cover in your show in just an hour, there's a lot for a client to have to sort through. And that's where a client advisor, financial advisor fits in the wealth management space. Right now, as you asked about the old 60-40 model, that is, I would say, the old model. The new model and what advisors should be doing with their clients right now is talking to them about diversification, rebalancing, and a lot of that rebalancing is out of the public markets and into private markets.
And with that in mind, is that what you're seeing a lot more interest in, as it were, from clients on the wealth side? You're a veteran of this, so the opportunities are for the clients more in private markets, private credit. We've done a lot on private credit here in the past couple of weeks, and private equity. Is that where the big opportunities are? Yeah,
if you look at allocations right now, Manus, across the industry, you're probably around 4 to 7%. And most of the CIO type teams are recommending 15 to 25% for ultra high net worth clients. So there's a significant shift to occur. It's not a shift that's going to occur immediately because clients need vintage diversification in addition to style and manager diversification. So this is if you think about wealth management being the long-term bull trend in terms of an advice market, then there's a double bull on the side of the alternative managers in terms of servicing wealth management clients.
Tom, someone once told me, a private equity manager, that every manager in their back pocket has a plan to go public at some point, but it's been a challenging market for IPOs. Manus and I spoke to Philip Freisa, co-head of European private equity at KKR yesterday, and he told us that the route of IPOs moving forward is going to continue. Tom, just take a listen to that.
Unfortunately, the next boom is not just around the corner. This is going to stay tougher much longer. Great companies will have space to go public, but you will not see what we saw before, a large series of IPOs with companies of average quality. We have not seen, and I've done this for 22 years now, as much interest in public company CEOs, in entrepreneurs and families to take their companies private today than we've ever seen.
So, Tom, we used to be in an environment where asset managers, advisors, they would go public. Is that over? Do you see that sort of exit route for the type of companies that you're taking?
No, Danny, it's not over, but in the current environment, it's not the preferred route because it's not the best way to secure capital and the valuations that you want to see. So I think the private equity market is certainly quite robust in terms of being able to evolve to different situations. I'd say today, a lot of times you can see better valuations on exits in the private space versus the public space, and until that shifts, that'll be the direction of travel.
I want to get a sense of where you want to sort of beef up the array of companies that you've got money in. Danny and I were just looking at some of the deals we've done. JP Morgan bought out Nutmeg, obviously. Then you've got Goldman's doing deals in Chicago, etc. In your space, the natural question is it going to be all US deals that you're going to try and look at? Are you actively looking in Europe and the UK? Is it culturally a better fit here, tech wealth, than it is there?
So I would say if you're thinking about tech enablement, tech enablement's going to work globally. And our portfolio, although being primarily focused on the US, does have some international exposure, including in the UK.
Hey, Tom, you know, there's some stuff for sale here in the UK, specifically OD Asset Management. There's been lots of reports that they're looking at selling parts there, given the drama. Would you ever buy anything from them? Have you gotten a phone call from them?
I wouldn't comment on anything specific in terms of names.
Deftly sidestepped. No calls, no comment. Well, we'll come back to that in a wee moment. We'll give Tom a little bit of a break. He's braved 6-7 minutes so far, Tom Naratil. Lightyear Capital stays with the brief team. We discuss the macro environment. We get his outlook. We might even sneak a question in on UBS. This is Bloomberg.
The dots at the September meeting had 12 of the 19 participants indicating one more hike. I'm less of that view now. I think given that, as I said, the bond market can do some of the Fed's job for it, you know, if even some of this recent increase were to stick, I think the Fed could well be done.
Former Fed Vice Chair Richard Clarida there discussing his reasoning on why we might have reached the end of the Fed's rate hiking cycle. We're back with Tom Naratil, a former top executive at UBS, who's now an operating partner at private equity firm Lightyear Capital. You've seen a cycle or two, right?
One or two.
One or two. This bond market is given a serious swag. Jamie Dimon flies the kite that rates could go to 7%. You read a lot now. You're outside the day-to-day machinations of rates. But when you see the market so convulsed this week, can you see a scenario where we're really underpricing what more the Fed has to do?
I think it's a little bit less about what the Fed has to do. I think after being behind the curve, you know, they've caught up. They've made it very clear that 2% is the target. I think it's very important to listen to what Jay Powell is saying when he says higher for longer. I think he does mean higher for longer. But I do think some of the consequences that you're seeing in the longer end of the curve is, you know, what are some of the supply-demand fundamentals in the U.S. Treasury market overall? What's the compounding impact of higher rates on the federal deficit? And is there really going to be enough compromise in Washington to get the deficit under control? So I think some of those things are starting to feed through.
What could shift the bond markets convulsing this week? Because you ended with Washington and deficits. Could that be the trigger that causes rates to top out? Some kind of a fiscal...
Yeah, it could, but I don't think that's likely in the cards in terms of the current climate in Washington that we'd see a solution to that. So I think we need to see higher rates forcing the hand of policymakers in Washington to do what they need to do. So this is, I do think, you might say this is going back to my early roots, but it is the return to the bond vigilantes.
Tom, is there a world in which higher rates also force the hand of the Fed? We saw it in the gilt market. I realize they're very different markets with very different players in liquidity, but is there a risk that with these parabolic moves we've seen that it gets out of control and the Fed needs to step in?
Well, I think maybe it's, Danny, if that were to occur, maybe it's a bit of a step back. You know, we did, after a massive amount of QE, we're now in the process of QT, and we might be seeing some of the consequences of that. So the Fed has the ability to moderate that if they wish, but I'm not so sure, if you think back historically on where we've been in rates, that we're really out of whack considering where we are in the economy.
You see, there's the whole point. You've seen multiple cycles and multiple rate hikes. You've seen 15% with me in sterling. You know, when the Bank of England had to save themselves. So if we're just getting back to normal, Tom, in terms of rates, term premium is returning, real rates are trending higher. Do they continue? Do we continue? Are we at normal, or is there much further to go, do you think?
I think there's a bit more to do on the upside in yields. I don't think it's the 7% number. That's possible, but I do think another 50 basis points or so is something that the market could absorb well, and it would probably reflect where we are in the economy. I think if you look at what's happening with labor here in the United States, the labor market's pretty firm. At the same time, if you look at strikes that are going on, if you look at some of the pay increases that unions have been able to negotiate for their workers, the worker who's not in a union is going to start to ask some questions to their employer about what their pay raise is going to be. And I do think that's going to keep some pressure on inflation, make this last move down towards 2%. The last 180 basis points or so is going to be a heck of a lot tougher than what we saw previously.
Just to put it plainly, do we need a recession to get there? Is that what the next move is?
Danny, I don't think it's a traditional recession in the way that we've known it. I do think we may see a rolling recession, or we may in fact be seeing a rolling recession right now. That'll keep the GDP figures still in positive territory, slightly positive, but we will see labor adjustments in certain sectors. We will see declines in production in certain sectors. But overall, the consumer in the U.S. still appears to have a pretty good heartbeat.
One thing we are tracking is the short interest on some of the banks. We saw the SVB, the First Republic crisis. The market is now shorting banks like Bellio. Do you think we could have another, are we building up under the hood some other banking issue with this kind of shorting going on and the flow of money into market funds? Is the ruction done?
Maybe I would talk about that a little bit differently, Manus. I'm not so sure that where we are at this point is the place to add to that short currently. But I do think there are a lot of headwinds that you're seeing. We'll certainly see how that's reflected in third quarter earnings seasons for the major banks. Mm-hmm. But I would say regulators certainly noticed what happened in terms of the banking crises that we saw earlier in the year. And as a result of that, capital requirements are going up. Capital requirements going up, liquidity requirements going up, ROE under pressure. That certainly leads to someone wanting to take maybe a less long position in banks.
I bet you're relieved that you don't actually have to sit around the board anymore at UBS and sort of talk about capital requirements and liquidity. But we'll give this a go. I mean, it's been an amazing year in Swiss banking. Sergio Motti is back. The two beasts of banking are born. It was a marriage of great inconvenience. What is the biggest structural problem in this integration? What's the biggest challenge in this integration for Motti and the team?
So first, I think if you look at what Sergio and the team have laid out in the past earnings announcement, it's actually quite clear. Now it's just all about execution. So what are the areas of focus in the execution? First is run down the non-core assets, which have been identified and ring-fenced. The second component of that is the integration of the components of the bank that are going to be merged together. You see that in the Universal Bank in Switzerland. You see that in wealth management. You see that in the investment bank. You see that in asset management across the board. And then have your shareholders comfortable with the fact that your core businesses are still operating quite well. So I think if you think about the challenges that face UBS, this is like a perfect Hollywood casting moment. And Sergio Armati is the right CEO for the challenge at UBS today. If you look, you've got a very solid and strong chairman in Colm Kelleher, and you've got a very experienced executive board team.
Well, Tom, they tried to cast you in this Hollywood narrative. We've got the reports that Sergio called you up to get you to join. What was that phone call like? How'd you turn down the silver fox himself?
Well, the only thing I could say is I'm not so sure I'd always believe everything I read in the press.
Well, Tom, I think you would have fitted in great with the Hollywood door revolves, you know, Tom. You can always make a comeback. Sergio certainly did. It's been great to see you. We wish you well with Lightyear. Come back and talk to Danny and I with your first exit. Make sure that we get the exclusive on that, on when you do a deal. We wish you well. Thank you for giving us your time this morning. We appreciate people getting up early in New York. Tom Naratil, Lightyear Capital, on the brief this morning on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London. Manish Cranny is in New York. And let's get you set up for your trading day and a look at what is ahead. It's going to be a big day for Fed Speak. We're going to be hearing from Loretta Mester, Tom Barkin, and Michael Barr. Also, tune in for our interview with San Francisco Fed President Mary Daly. That's at 12 p.m. Eastern. Plus, we're going to get another round of jobless claims in the U.S. That's at 8:30 a.m. Eastern. Can the jobs data yet again cause ruptures in this bond market? And EU leaders are meeting in Grenada today and tomorrow as support for Ukraine has come under increasing threat. But, Manis, again, as I said, we've seen time and again over the past few months that it is the data that sets off different directions and a lot of losses in this bond market.
Look, we had this eruption parabolic moves on the back of the JOLTS number coming in stronger and more muscular, I think, than the market had anticipated. Then ADP gave us that, you know, bad news is good news. We just had a conversation with Tom Naratil saying he thinks the market can take another 50, 60 basis points in terms of the upside in yield. And I think that was an interesting take. He talks about fiscal largesse, and he talks about the bond market putting pressure on Washington.
Yeah. And I also think the point he made was really important, that what the bond market is doing, you can see 10-year yields are not to move today, but it makes sense based on what's happening on this economy, that there's more inflation, that there needs to be higher and longer. For all of those really worried about the ruptures in the bond market, Manis, perhaps it makes perfect sense because we need to price out some of the cuts that were priced in for 2024.
Absolutely. And I love the Barclays note, which says, look, there's no magic level in this bond market that would make it a buy. You're going to have to see stocks tank furiously before you take on a little bit of bond risk. And that oil market is definitely demand destruction wrote large. Danny.
All right, that's it for Bloomberg Brief. Surveillance is ahead on Bloomberg.